Good morning, we made it. It's Tax Tip Tuesday, 52 out of 52. So, pensions. Following from last week's Tax Tip Tuesday regarding your estate after death, hopefully before that occurs, you will be able to claim your pension. Now, I'm not talking about the state pension here, I'm talking about the personal pension that we can all save into and our employers contribute towards as well. So most people know that you can take a tax-free lump sum of 25%, which is usually at the age of 55 at the earliest. But I thought I'd share with you some further information that I think you should be aware of. Now, obviously, I'm an accountant, I'm not a financial advisor, so I can only really talk to you about the tax implications surrounding pensions, but there's plenty to cover just with that. If you do want further advice on pensions, I have some great contacts, or I would always advise you to speak to your financial advisor. So the Pensions Act 2008 contained new legislation that was introduced gradually. It started with the largest employers and the minimum contribution increased. Since 6th of April 2019, the minimum contribution has been 8%. That's 5% and 3% contributed by the employee and the employer respectively. You can contribute more than this if you wish into your auto enrolment pension, as can your employer, subject to the limits, which I'll talk about in a few minutes. So under the new legislation, an employer must offer an auto enrolment pension scheme and employees must be automatically enrolled into the scheme. That's if they have certain earning levels and are aged between 22 and state pension age. Now, an employee can opt out of the scheme if they wish, but they must do so without employer influence. And they must also do it within a certain opt-out period, which is 1 month from the later of the date they became an active member or the date that they received a letter from their employer with the enrolment information. So you can't opt out outside of this window. To cease making contributions is to cease your active membership. If an employee opts out, the employer must refund all of the contributions they have made, but the same does not apply when ceasing an active membership. So if your employee was to opt out of the pension and they did so within the relevant timescale of you auto enrolling them, then you would have to refund their contributions. Obviously, you could claim those back from the pension provider also if you have already paid them over. So in order to opt out, the employee must obtain an opt-out notice from the pension scheme. And this is to avoid any employer involvement in the opting out. So as mentioned before, an employee must choose to opt out of the scheme themselves without any influence from their employer. I'm not going to lie, I've come across a few clients in my time that have said, oh no, I'm not going to bother with the auto enrolment pension for my staff. Yeah, it's not optional. So if the opt-out notice does not contain all of the statutory information that it needs to, then the opt-out period extends to 6 weeks in order to give the employee time to correct the errors. Now then, tax relief. So the maximum amount of contributions on which a member can have relief in any tax year is potentially the greater of £3,600 or the amount of the individual's relevant UK earnings that are chargeable to income tax for the tax year. So net relevant earnings are made up of various sources of income, such as employment income, benefits in kind, sole trade or partnership income, furnished holiday let income, the list goes on. Tax relief may be given at source, through your employment, or entered on your tax return. We then have the annual allowance. So this is the amount that you can contribute to your pension pots. It's not the amount that you can receive relief on. The annual allowance for most people is 40,000. It can be lower if you have threshold income over 200k or adjusted income over 240k. Prior to 6th of April 2020, these limits were 150k and 110k. If either of these limits apply to you, then your annual allowance tapers down. Threshold income is considered first. Adjusted income is only considered if your threshold income is over the limit of 200k. For every £2 your adjusted income goes over 240k, your annual allowance for the current tax year is reduced by £1. The minimum reduced allowance you can currently have is £4,000. Prior to 6th of April 2020, it was 10k. If you do not use your annual allowance in a tax year, it may be carried forward. You can only carry forward unused amounts from the previous 3 tax years using the earliest year first. We then have the lifetime allowance. So this is the total amount that you can build up in your pension pots. If the amount becomes higher than the allowance due to reasons such as the allowance being reduced, then you may be able to protect the amount already in them. The lifetime limit is currently £1,073,100. Tax charges. So if your pension contributions or pension pots go above either of these limits, you may be subject to a tax charge. If you go above the annual allowance, this will be included in your tax return. In certain circumstances, your pension provider will pay the charge from your pension pot. You may make an election for this by the 31st of July following the end of the next tax year. So if you've had a charge on your 2021 tax return due by 1st of Jan 22, the claim needs to be made by the 31st of July 22. If you go above the lifetime allowance, your pension provider will deduct tax. This may be reported on your tax return. There are certain instances where your pension company may ask for information from you in order to determine if a tax charge is due. Now, an important bit to note here, the allowance and limits apply to any pension pots that you have. They are not limits for each pot. So that's it from me in regards to pensions. If you do want to make additional contributions to your pension pot before the end of the tax year, please get advice. If you want to do anything with your pension, please get advice. Speak to an IFA, they will work hand in hand with us as your accountant, which I've said before, we do all work closely together. Thank you all very much for listening to me babble on about tax for every week of a full year. So that's it from me, but don't worry because this isn't actually the end of Tax Tip Tuesday. If you follow me on LinkedIn, you will soon see why, but from me, that will be all. So I hope you all had a lovely Christmas. Thanks again for your support during 2021, and I wish you all a very happy new year.